Thank you, Master of Ceremonies. The Honorable Colm Imbert, Minister of Finance, the Honorable Brian Manning, Minister in the Ministry of Finance, His Excellency Arthur H.W. Williams, High Commissioner for Jamaica to Trinidad and Tobago, heads of the regional stock exchanges, Mr. Ian Narayan, Chairman of the Board of Directors of the Trinidad and Tobago Stock Exchange, and other distinguished members of the board, Chief Executive Officer of the TTSE, Ms. Eva Mitchell, and staff of the exchange, special invited guests, members of the media, ladies and gentlemen, good morning. On behalf of the Jamaica securities dealer community, I want to extend a hearty congratulations to the TTSE on achieving its 40th year milestone. I've been watching keenly with admiration the progress made by the exchange over the past few years. Initiatives such as the enhancement of tax incentives for SME companies listed on the TTSE will without a doubt increase the vibrancy of the domestic capital markets. Additionally, the facilitation of cross-listings will allow for greater integration across borders, not only in terms of mobilization of capital, but deeper economic integration as well. Wearing my hat at NCB, it is a journey that we are committed to, having last year become the 7th stockbroker on the exchange. I've been invited to speak on the role of market making in building stronger capital markets in the Caribbean. I start my presentation with two important assumptions. The first assumption is, since I'm asked to speak, I'm assuming that the Jamaican experience, both good or bad, is relevant to the topic. The second assumption is that the topic is relevant not just to individual markets within the Caribbean, but also as a collective across the region. Before we explore the importance of market making, I believe it's important that we fully appreciate the importance of the capital markets in the financial sector ecosystem. And the Prime Minister of Jamaica and Jervis Warner would have touched on some of these earlier. The capital markets at the core are financial markets that bring buyers and sellers together to trade stocks, bonds, and other financial assets, and enable businesses to raise financial capital or patient capital to grow and transform. This can be in the form of debt or equity. In essence, the capital markets channel the wealth of savers to those who can put it to long-term productive use while providing an attractive rate for savers. The capital markets provide that bridge for those that are in need of financing and those that have the risk capital to invest. It is not only an alternative to bank financing, it also complements it because by regulation, commercial banks are restricted from providing the type of longer-term or unsecured risk capital that the businesses may need. And firms need capital in the first place to access borrowing. The capital markets are also a critical funding source for infrastructure development. These developments have strong socio-economic benefits through the construction of roads, water and sewage systems, housing, energy, telecommunications, public transport, etc. These projects are ideal for financing through the capital markets via long-dated financing solutions. The traditional banks simply cannot provide 30 to 40-year funding. Moreover, the capital markets promote public-private sector partnerships to encourage participation of the private sector in productive investments. The need to shift economic development from the public to private sector to enhance economic productivity has become crucial as regional governments continue to be financially constrained. The correlation between capital markets development and economic growth has been well established in the empirical literature. Capital markets mobilize additional savings, making more capital available to companies, which may in turn create jobs and facilitate real wage growth. It also helps in diffusing stresses on the banking system by matching long-term investments with long-term capital. Additionally, empirical evidence links capital markets and innovation. as well-developed capital markets play a key role in financing of technology and more generally of riskier projects and enterprises which are not usually financed via traditional lending. The ecosystem supporting the capital markets can be large and complex. The providers of capital and those seeking capital in the capital markets do not stand on their own and are supported by a wider network that work together to make financing possible. In the secondary market, there are 4 stakeholders other than the buyer and seller of securities that are very important. There is the securities dealer, the broker, people like me. These are institutions that facilitate the trading of instruments on behalf of investors. Some use their balance sheets to take positions to facilitate market making. And these dealers, brokers, are market makers. Second is the infrastructure, market infrastructure providers. They include the exchanges that facilitate trading, custodians that hold securities, registrars, paying agents, settlement platforms, as well as accountants and lawyers, to name a few. The third is the regulator. The overriding objectives of the securities regulator are the protection of investors, ensuring that markets are fair, efficient, and transparent, and as far as possible reduce systemic risk while facilitating market development. And fourth is the government. The government is responsible for setting policies geared towards market growth and development, with there being an overarching economic growth agenda. Now let's explore market makers and their relevance to the financial markets. A market maker in our markets are typically securities dealers that buy and sell securities at all times for its own books in return for a profit. So what is the relevance of market makers to financial markets, especially developing markets such as ours? Market makers help to ensure the smooth functioning of financial markets by investors to buy or sell securities. How do they do this? They buy securities when there is oversupply in the market and sell securities when there is an undersupply. When the demand for security is low and supply is high, the market maker will buy the securities. When the converse is true, market makers will supply the market with securities to meet the demand. In doing so, they help to ensure adequate volume of securities so trades can be done seamlessly at all times. Market makers ensure liquidity. Market makers provide the following benefits to financial markets. In providing liquidity to financial markets, they help to support price discovery. They stand ready to provide quotes for securities, thus providing the market with pricing where trades actually take place. Additionally, by being available to buy and sell securities, market makers ensure that investors can know current prices for securities, that is, prices do not go stale. Market depth is also closely related to liquidity. In deep markets, large transactions can be executed without having a significant impact on prices. Market makers buy excess supply and build inventory, especially in the case of large transactions that have the ability to impact prices significantly, thus helping to create deeper markets. They play a critical role in ensuring that the success of primary market transactions. By taking a position in these transactions, potentially taking up excess supply of primary market security, market makers allow primary market transactions to be executed faster and more efficiently. And this will be critical as the exchange embarks on its journey of listing multiple SME institute entities. Furthermore, in times of financial stress, markets become more volatile, and literature shows that when volatility is persistently high and bid-ask spreads are wide due to supply and demand imbalances, the participation of market makers increase significantly. In fact, a 2009 report done by the Emerging Markets Committee of the International Organization of Securities Commissions found that market makers in general add to the stability, liquidity, and transparency of financial markets, and therefore are highly desirable participants in emerging markets. Having established the importance of the capital markets in the financial ecosystem and the importance of market making, let us now explore the evolution of Jamaica's capital markets and the role played by market makers in its development and deepening. Jamaica has a very interesting story. I've been told that Jamaican dealers are very aggressive. As a matter of fact, it's a commonly held view that Jamaicans generally are very aggressive. Many have attempted to explain this phenomenon dating as far back as the colonial days. But what is true, though, is that Jamaica's capital markets is the most active in the English-speaking Caribbean, and a big part of that has to do with the role played by market makers, both on the debt side and on the equity side. For the purposes of this discussion, I would argue that one could look at the evolution of Jamaica's capital markets and market making in three phases: the early phase, the growth phase, and the consensus phase. The early phase began 53 years ago in 1968, when the Jamaica Stock Exchange, JSE, was founded, and ended in the late 1990s, when Jamaica experienced a financial crisis. The establishment of the exchange started an early capital markets culture. Within the first year, the JSE listed the ordinary shares of 34 companies incentivized by government policies. 4 to 5 years later, this peaked to 42 companies in that era. Additionally, there were a number of corporate debt and preference shares, some convertible, that were listed. Imagine that level of sophistication in an open outcry market of the 70s. During this period, market turnover as a percentage of market capitalization was as high as 10%, with an average close to mid-single digits. And I believe the turnover now in Jamaica is around 2%, a little over 2%, and a little under 2% for the Trinidad and Tobago Stock Exchange. The early successes can be attributed to not just policy directives, but the fact that at the onset, brokers undertook the role of market makers, as they were encouraged not only to act as agents, but to trade as principals. The growth phase started in the late 1990s, the longest phase, and saw developments that propelled the industry through several transformations with the emergence of the securities dealer industry as we know it today. This phase began with the sovereign debt market, catalyzed by a business model that was once centered around the intermediation of Government of Jamaica instruments. This was funded by repurchase agreements that complemented the existing equity offering of brokers. At the time, the government had an insatiable appetite for debt, while institutional investors and the average investor had a similar appetite for high-yielding short-term instruments, such as repos. Like most debt markets that are in a nascent stage, the sovereign securities ended up being the catalyst for debt market growth and development. As rates trended down towards the latter part of this phase, triggered by a significant reduction in GOJ borrowing, it facilitated a gradual reemergence of the corporate debt market and the expansion of the repo market to include corporate debt securities. It is this repo model that accelerated our market-making culture as securities dealers became active holders and traders of GOJ and corporate securities. At the same time, the equities market continued to evolve. With it, the role of the market maker. Between 2000 and 2016, we saw the addition of 4 or more brokers to the JSE. This resulted in an uptick in market turnover and greater linkages between the Jamaica Stock Exchange and the Trinidad and Tobago Stock Exchange. We saw active trading of cross-listed securities and the presence of a Jamaican broker domiciled in Trinidad and Tobago. Positioning in the markets was the order of the day, and I recall as a young equity trader, not too long ago, I used to chase and exceed monthly income targets of 100,000 US just from market making of equities alone. In 2009, we had the creation of the junior market on the JSE. This not only transformed our market with the support of market making, but also saw the beginnings of a private equity culture by virtue of private investors viewing the junior market as a viable exit. This era was a defining period in our markets. Jamaica had tapped the international capital markets in a huge way, while at the same time embarking on a number of regulatory reforms coming out of the crisis of the 1990s. However, our macroeconomic indicators were weak. Between 2000 and 2016, Jamaica's GDP growth averaged less than 1%, while debt to GDP peaked at 138% in 2012. Jamaica was junk bond territory. These circumstances drove a very interesting behavior. Low economic growth and a volatile market fueled hunger and passion and market innovation. In arranging local capital markets transactions, dealers got very meticulous and creative in structuring our own investment-grade securities and making markets for sale, rather than relying on overseas investment-grade credits that we don't know the street address for. We focus on credits we were familiar with. This resulting in us making a market in our own local investment-grade securities, facilitating higher yields while achieving the desired objectives. And we had to build a whole ecosystem around that to de-risk our own investment-grade securities. When the 2008-2009 global financial crisis hit, our homegrown securities stood up, and those that didn't, we knew where to go, who to call, and work things through, as opposed to those international securities that went belly up and bondholders had to line up behind each other in hope of recovering a portion of their investments. When the GOJ global bonds tanked, it was the local market makers that supported the bonds across the yield curve, avoiding contagion into the domestic financial system. When the GOJ resorted to the IMF in 2010 and had to go through a debt restructuring exercise, two restructuring exercises actually, the entire market came together around a consensus of putting our competitive biases aside to focus on Jamaica first. Right? As I said, it was a very defining moment for us. We collectively worked ourselves out of the crisis, and we wouldn't have been able to do so with overseas investment grade, say mortgage-backed securities that turned junk grade overnight. As we achieved macroeconomic stability and we started feeling the effects of GOJ's fiscal reforms, which led to gradual reduction to GDP towards a target of 60%, we saw increased appetite on the part of corporates to tap into the capital markets. As a matter of fact, the size of the non-bank financial system in Jamaica today, which are active participants in the capital markets, is just under 2 trillion Jamaican dollars, exceeding that of the banking system. So it's fairly large. The next phase, the current phase, is the consensus phase, which I'd say started in 2017. And it is in this phase that we saw tangible demonstration of acceptance by the government and the regulators that the domestic capital markets play a critical role in driving financial inclusion, wealth distribution, and economic growth. And our Prime Minister touched on that earlier today. With this in mind, the government of Jamaica in 2018 established a capital markets deepening committee chaired by then recently retired Chief Risk Officer of the IMF, David Marston, who is actually a Jamaican. This saw an acceleration of a number of market-enabling reforms. We saw reforms geared towards expanding the allowable assets for institutional investors such as pension funds and insurance companies. There were reforms that made it easier for issuers to tap into the capital markets. One such reform was geared towards encouraging companies that were already listed to be indifferent between a public listing of debt and a private placement, which in Jamaica takes only 2 weeks to register. The promotion of a local ratings culture was embarked on, along with steps taken to enhance the liquidity of instruments in the market. There was the acknowledgement that market makers are key in this regard and represent an important player in deepening the markets and thus enabling more robust GDP growth. On the agenda now is capital reform. And while this reform is focused on strengthening the resilience of the financial system, it is also designed to facilitate greater market making, which requires balance sheet and optimal use of capital. In a short time, we saw the regulator change its posture from one that was viewed as anti-market to being co-champion of market growth and deepening. I've had the benefit of being JSDA president during this phase, and I can say that although not perfect, we have seen a more consultative regulator and a significant narrowing of the trust deficit that is typical between regulators and practitioners. And I'm sure Dr. Marlene Street-Forrest will back me up on this. There has been the creation of end-to-end digital platforms, right? There's the creation of the Go IPO platform, which facilitates participation in public placements from anywhere in the world digitally. And this was actually spearheaded by NCB Capital Markets, which we rolled out in Jamaica first and recently in Trinidad. And I could go on as it relates to some of the stuff that Jamaica did to enable growth and development of the capital markets. These reforms were all critical. What is clear from the Jamaican experience is that all market stakeholders have a role to play in encouraging market-making activity. In many developed markets, the three critical players are the government, the regulator, and the securities dealers, or brokers, if you may. And I'm going to start with the government and the regulator. And I'm also going to point to the Singaporean experience. For many, Singapore is touted as the capital markets model for developing countries. Singapore has developed its capital markets and regulatory framework to become a financial hub to reckon with, capturing top spots in several international rankings. Global management consulting firm McKinsey & Company, in its April 2017 Banking and Finance Report titled Deepening Capital Markets in Emerging Economies, shared a 6-step approach on how Singapore was able to carry out a successful transformation, and I encourage you to actually read it. If I am to sum up this approach, it started with the creation of a very bold vision that was driven from the very top of the political chain. The regulator was empowered and a regulatory framework created that was very pro-business. And thirdly, a mindset shift occurred, supported by relentless execution. Policymakers and regulators should not underestimate the impact they have in transforming market dynamics. The simple policy change, I believe, 2 years ago to encourage SMEs, or to further encourage SMEs listing on the TTSE, from my vantage point, over the next few years will singularly transform the TTSE and play a critical role in capital formation and ultimately promote a culture of private equity. Securities dealers, through their market-making activities, play an even more important role in driving market deepening. I'll go back to what happened in Jamaica. Market development and innovation were driven by the local brokers. The regulator and the policymakers were forced to catch up and ultimately become enlightened. The success of the SME market and other initiatives will largely depend on the dealers, the brokers. The approach should not be to only arrange transactions, but rather brokers need to take positions and make markets. By doing so, brokers not only help to drive market expansion, but have the opportunity to earn significantly more economics. I've lived this in my past life, and I say past as I now see myself as a Caribbean practitioner, not just a Jamaican practitioner. Yes, there are country-specific nuances, but I can assure you that the journey will be similar in many respects across the region. In fact, in Trinidad, the firms that are best positioned to make markets here are the Trinidadian brokers. The reality is that for market making to be effective, it requires a concerted effort from all stakeholders. Importantly, it will not unfold overnight, but the important thing is to start. Before closing, it would be remiss of me not to touch on regional markets integration. The reality is that market making is more impactful when there is scale. Right? That's why the initiative to launch the index and to further deepen the markets or integrate the markets, and what I heard Ms. Michelle said earlier on in terms of revisiting the CXN, these are things that I encourage. In today's environment, the buzzwords are transformation, disruption, mindset shifts, ecosystem plays, to name a few. These are words that we use at our board meetings, staff meetings, and even conferences. The region as a whole, the reality is that the region as a whole is filled with tremendous opportunities, and we are seeing significant cross-border commercial activities as businesses embrace regional commerce. Globally, the pace of innovation is at an all-time high, and this has not escaped financial markets ecosystems. While at the same time, as a region, there are significant challenges as it relates to the mobilization of capital across jurisdictions. These challenges are a result of regulatory and foreign currency issues, as well as mindset issues, to name a few. What I've just described, ladies and gentlemen, is a recipe for market disruption. Opportunities, challenges, an environment of innovation, that's a recipe for disruption. While regional exchanges have made significant strides when it comes on to innovation, more needs to be done in bringing the markets together. If we do not accelerate that agenda, we run the risk of stock exchanges as we know them today becoming artifacts of history and literature. We are seeing this take place with payment platforms that are becoming increasingly interoperable. Let us be more proactive, and I say us, Marlene, because I'm a director of the Jamaica Stock Exchange as well, in joining forces to positively disrupt ourselves as opposed to being disrupted by new emerging forces. To the TTSE, thank you for the opportunity to share this morning. Again, congratulations on your milestones, and I look forward to be in here in the next 40 years when you celebrate your 80th anniversary. Ladies and gentlemen, enjoy the remainder of the conference, and I look forward to seeing you next year. Thank you.